Good afternoon, everybody. Welcome to the webinar today, Ask an Auditor. Thank you for joining. My name is Nishant. I am one of the founders of Monaeo. I have been working with taxpayers for the past 8 years, helping them get ready for residency audits. I'm joined today here by Tim Noonan, who is a partner at Hodgson Russ, and he leads the firm's tax residency practice, has been doing this for more than 20 years, has handled more than 1,000 audits, several famous cases like the 2014 Guyad case, widely published and speaks often on this topic. Also, today with us is Kristine Bly, who is the Senior Audit Manager at Hodgson Russ. She's been working in the residency space for more than 10 years, was previously with the New York State Department of Taxation, where she had extensive experience working on residency cases. The topic around residency audits is hot. The New York State Tax Department specifically has been very, very productive in this area. We got some information from the State Tax Department, which helps put some hard numbers behind what we already know to be the case, that the state of New York has been very aggressive in this area. Based on some data that we got back as a result of a FOIA request that we put in with the New York State Tax Department, what we've learned is that the department currently is doing roughly 3,000 audits every year just in the area of non-resident taxation for high net worth individuals. The data also suggests that in 52% of these cases, the state is able to prevail and is able to show that the taxpayer is indeed a resident of New York State. The state is collecting roughly $145,000 in each of these cases, 20% in interest and penalties, and they have now collected more than $1 billion from this residency program over the last 5 years. That actually is far greater than the amount of dollars that they collect from all S-Corp audits that the State Department is doing. I'm going to hand this over to Tim Noonan to give a quick background on residency audits.
All right, thanks, Nishant. And so, yeah, guys, today I'll give a little bit of background, and then we have the highlight, of course, is not me and Nishant. It's Kristine Bly to talk through and answer a lot of your questions on what happens in these audits and in these kinds of cases. You also can probably hear we're speaking to you from New York City, where we're 24 floors up, and I can still hear fire alarms and car horns, so sorry about the background audio. So, guys, we think about residency and why it's so important. Residency really is the centerpiece of state taxation. It's how states determine whether or not, in part, a taxpayer is subject to tax. The old joke is that if you're a resident of New York, your tax calculation is very simple. You're taxed on one thing, and that one thing, of course, is everything. And over the past couple of years, and really the past 18 months, this residency issue has become so much more important because of federal tax reform. And the reason, as all of you probably know, is that effective in 2018, taxpayers could no longer deduct state and local taxes, or I guess to be more precise, they could only deduct $10,000 of state and local taxes. What that means now is the cost of paying your state taxes has really gone way up. It used to be if you paid $100 in New York tax, if you weren't in the AMT, you would be able to deduct the state tax as an itemized deduction. So $100 in state tax might actually only end up costing you $65 or $70 because of the deduction you'd get at the federal level. Well, that went away, and what happens with that going away is many taxpayers now are looking at the weather outside and the traffic and all the other problems they have in their life, and in addition to all that, realizing that, wait a minute, I can't even deduct my high state taxes that I pay in this high tax state. And it's causing a lot of people to think twice about where they live, and it's causing a lot of people to think about these residency issues. So When people do that, when people try to move to another state, they're undoubtedly going to get audited, and we'll talk a little bit about that later. But when an audit comes up, there's going to be 3 or 4 things that the auditors are going to be looking at. First, they're going to be checking to see where you live, this domicile test, where your permanent or primary home is. So that's a very subjective test. And the auditors are going to test that out through a variety of different factor-based tests, again, to get at the subjective question of where your primary home is. The next issue is statutory residency. So even if you are domiciled in another state, even if you live in another state, you can still be taxed as a resident, of course, if you meet the statutory test, which is you have living quarters in New York, a permanent place of abode is what the law calls it, and you spend more than 183 days in New York. This is where we get into the fun exercise of counting up someone's days. Obviously, that ends up being a huge part of these audits. Next, even if you're a non-resident of New York, you pass the domicile and the statutory tests, you can still potentially owe New York taxes based on earned income, based on sourced income. So auditors are also trained, in addition to doing the residency checks, to make sure that any other income that shows up on the taxpayer's tax return to determine whether or not that income can be taxed in New York because, again, it was earned in New York or sourced in New York. So we see a lot of issues there now, and a lot of that comes through audits of flow-through entities, partnerships, LLCs, S corporations, and the like. They're a growing target of audits, and again, not so much on the entities because the entities don't pay tax, but on the individual non-residents who might be receiving income from those pass-through entities. So that's the third thing, and then the fourth thing is, frankly, a little bit frustrating, but auditors in New York also basically put on their federal tax IRS uniform and sometimes will essentially do audits of federal tax issues, basis, distributions in excess of basis, loans to shareholders, issues that normally would be the province of an IRS auditor. The New York Tax Department auditors, perhaps because they realize that the federal tax auditors aren't as aggressive, and perhaps because they're good at what they do and they're looking to audit all issues, we end up seeing federal tax issues come into play as well. So a couple big things in audits before we get it over to Kristine. And first thing to think about is the burden of proof. So the burden of proof is a critical aspect of these cases. Sorry, Marty, we lost our slide. Get us to slide 7. Sorry. So burden of proof. So the basic idea here is you are guilty until you are proven innocent, and that's a difficult thing in these audits. You think about it in the day count context. If you can't prove where you were in New York. That's the burden of proof question, and the test is based on clear and convincing evidence. Here we go. So clear and convincing evidence means it can't be a close call. So in a domicile case, if there's a question as to whether or not the taxpayer was able to establish a move to Florida, if it's 50-50, that kind of thing, what happens is it becomes difficult for a taxpayer to win that case when it's a close call. That's the burden of proof thing. Also, it comes up in day count cases as well. If you have a taxpayer, I've had many taxpayers who say, who used to say, hey, I use cash for all my transactions, so no one really knows where I am. Well, the problem is if no one really knows where you are, you were in New York, so you have the burden to prove where you were, and you have the burden to prove where you weren't. So that is the burden of proof, the burden of proof issue. So that's that. The next part about the audit process that's kind of interesting is the question of whether or not your client will be audited. And the answer is yes, they will. There is no lottery in New York. There really is no audit roulette. If you're a high-income taxpayer, you claim a change of residency from one state to another, you're going to get audited. The audit likelihood is really at 100% based on our experience in helping a lot of taxpayers with these cases on the front end. The tax department is extremely sophisticated. They got great data. They know how to analyze that data, and they know how to find people who are claiming residency in another state. There's also a question on the tax return. The question asks, do you or your spouse maintain living quarters in New York? If you check that box yes, it's most likely you're going to get it audited. I often think that question could instead say, would you or your spouse like to be audited by New York, yes or no? That's a box that also often leads to a lot of audits. So that's the audit lottery. Once you get your winning ticket, what happens? Well, the audit is done by a tax department auditor. They're going to send you a letter, and there's going to be a series of information document requests where they're going to ask us questions. We're going to respond to them, and most cases will get resolved in the audit process, but there's a lengthy appeals process that you can go to. There's a mediation process called BCMS. There's a tax appeals process in the Division of Tax Appeals, and then you can even, if you're lucky, go to court. So the process can be long and painful. Most of the time, though, the process starts and ends in the audit phase. So when you're in the audit phase, and getting sort of to the point of our presentation here, is you're going to have an adversary. You're going to have an employee from the New York Tax Department who's going to be auditing you or your client, asking questions, sending the IDRs, and that auditor will be the primary person in charge of gathering all the data, and a lot of the back and forth that you'll have with the tax department will be through this auditor. That auditor has a supervisor. That supervisor has a supervisor called a section head, and you have a group of supervisors in Albany that kind of oversee everybody. But make no mistake, guys, there's a lot of people doing this. There's 10 offices across the state. There's over 300 auditors. It's a big business for the state of New York, and they're very good at it, and they're very good at being aggressive about it too. So it's been a huge issue over the past couple of years. So today, we have a special treat. We have Kristine Bly, who currently is a senior audit manager with us at Hodgson Russ, but she has the unique distinction of also being a former auditor with New York State. Why in God's green earth would we hire a New York tax auditor? Well, I'll tell you why, because she's Kristine. If you ever heard the old joke about kids sitting around at the playground in third grade, and one kid says, hey, my dad's a race car driver. He can go 0 to 60 in 2 seconds. And the other son says, oh, yeah, my dad's a runner, and he can run a marathon in 4 hours. And the third kid says, oh, my dad's a state tax auditor. He works till 5, but he's home at 3. He's really fast. So the old joke is, work ethic on auditors, and they work for the government. Well, we had an audit with Kristine way back in the day, and she came in for the meeting at 7 a.m. Like, who comes in at 7 a.m.? Kristine does, and she stayed till 5:30. We said we should probably hire Kristine. I think she's a hard worker. So we did end up hiring Kristine, and she's been with us she's almost 10 years. And we thought today would be kind of a neat experiment to talk through with Kristine sort of, and again, what she's seen, what she saw as an auditor, and quite frankly, what she's seen almost over the past 10 years on the other side with us dealing with these cases. Obviously, a caveat is she's clearly not speaking for the New York State Tax Department, who no longer employs her. And there's also sort of somewhat ethics rules that maybe prohibit her from telling you everything, and telling us everything, actually, which is frustrating, but she doesn't tell me everything either. But so there are those issues out there, but we thought this would be an opportunity for everybody to, again, ask questions, so you do have the ability to ask questions on our WebEx interface here. If you go to the bottom right-hand corner of your screen, there's a little spot where you can write in a question. Please direct the question to all panelists. The panelists are, myself and Kristine and Nishant. If you send it to some of the other categories, everyone in the world is going to see your question. But so just send it to all panelists. We'll see them. We're going to take questions as they come in. We've already got a number of questions from folks that we'll be asking Kristine as well. But, for the remainder of the program here, shoot our questions. We'll get to as many as we can, and, we'll have some fun with it. So Nishant and I are both going to be asking questions, but maybe Nishant will start with you.
Awesome. All right. Thank you. Thank you for that great background, Tim. I think it helps folks understand, the data that we saw earlier on, and validate some of the things that you are seeing from your experience in audits as well. So, Kristine, before we get started, maybe you can just give folks a little bit of background about how long did you work for the tax department, what was your official position there, and what kinds of cases were you handling while you were at the state?
All right, thanks, Nishant. I worked for the tax department prior to 2010. I started actually as a full-time summer intern. I ended up enjoying the work that I was doing, so I decided in my last year of the accounting program at the University of Buffalo to stay on, and ultimately was hired as a tax auditor trainee, tax auditor 1 with the department. I was trained on a variety of taxes. I actually held field and desk audits for everything ranging from corporate franchise tax, banking, personal income, and withholding. Probably the only thing I didn't do was sales tax at the time. Those were both audits, again, that I performed at my desk and traveled around the country for.
Okay, that's great. That sounds like extensive experience. So when we talk about residency audits, we get a question a lot of times, people asking, how does an audit actually start? Is it that, you just get a letter from the state, or do you actually have folks who just show up at your home or office? How do these things start?
Great question. In most all cases, yes. You're going to get written correspondence to your most recent known address. Typically, that's going to be the last mailing address on your most recently filed tax return. I have seen instances where auditors have actually mailed that initial document request to 2 separate addresses, both your new home state address, so if that's Florida, as well as your prior historical New York address. And the one going to the New York historical address comes via certified mail. I find that was both clever and alarming of finding out whom is signing for your initial audit letter. Are you in New York in March when you get an initial audit notice? There are rare instances where your first contact is from an auditor in person. It's going to almost always be related to a criminal matter. So you should exercise, in that event, your right to an attorney. You should be skeptical of anyone that arrives at your doorstep and you've not received sort of a case number and an audit letter previously. Sometimes, sort of outside of the context of personal income tax audits, you may have an auditor that's at your place of business that is just there sort of scoping out how things go, placing an order, sitting down and having lunch. You're not likely to be able to differentiate them from any other customer that's coming in on that day.
All right, another question from the audience, Kristine. What do you consider? What would the tax department consider to be a high-income taxpayer?
Okay, so a high-income taxpayer, I mean, largely, so this goes to the point, it's public knowledge that the tax department reached out to IBM probably more than a decade ago to come up with a software program that generates algorithms specific to what it deems high risk / reward tax returns. The exact algorithms are outside of any auditor's pay grade and not up to them to determine. So you sort of get selected through that IBM computer programming. We have seen over the past 10 years that most of those returns for selection are going to be individuals whose income exceeds $500,000 in any given year. It's more than likely that if you exceed $1 million, that statistical rate goes up. So for instance, If you make more than $500,000 in a year, you're probably at a 50 to 60% likelihood of an audit. Once you pass that $1 million threshold, you're probably up past 90%, and when you get to the lucky number of 10 million, you know, you're probably in the 99.9% chance of being audited.
All righty. Next question, Kristine. So the question is, a client is living in New York City, but is considering a move to New York State. Is anybody, they're still going to be living in New York. Is anyone going to care about that?
Yeah, so both an audit, both a change of residency out of state or in the state from the city to, for instance, like Long Island or Westchester, is going to be scrutinized in the same manner as an out-of-state move would be. Within the tax department, there's both the City of Finance as well as the New York State Department of Tax and Finance, but City Finance acts as an agent of the department. So you can have a whole host of city finance auditors who are auditing specifically this issue, those people who are moving from New York City to New York State only.
All right, got it. Guys, you're sending a lot of questions. It's awesome. Keep them coming. I'd say there'd be a prize for the most questions, but there won't be. But still, keep them coming. So, all right, Kristine, shifting gears a little bit here, can the tax department, or actually the taxpayer, get a list of the cell calls that they made on their phone from the carrier to see where calls are being picked up? Can you talk a little bit about cell phones?
Yeah. So it depends on a couple of things. Primarily, it depends on who your cell phone carrier is. So let's start with Verizon Wireless. If your client or you're a taxpayer who has Verizon Wireless, this is no different than the department subpoenaing a credit card bill, right? The information relative to your location is contained on your Verizon Wireless billing statements. So the department can subpoena and or you can call customer service and get those bills. The issue with that is it's going to only show incoming and outgoing phone call activity. So neither you nor the state are ever going to get your location of text messages or data with that. AT&T is going to send much more in terms of records. However, and this is a big however, the state cannot subpoena an individual's AT&T wireless records without the notarized consent of the account custodian. So if you have a personal AT&T account, this is going to be you as an individual. If your cell phone is maintained by your employer, this is going to be probably someone in your IT department who's responsible for adding phone lines, etc. With that, you have to, so once you sign the notarized consent, the state will issue a subpoena, it'll accompany the notarized consent, and it'll go to AT&T. What comes back is a file from AT&T of every single text, voice, and data GPS connection, essentially. And when I say GPS, I'm talking about the latitude and longitude of the closest cell tower to which your phone pinged. For the most part, that information in raw form is not readable. It's not relevant. You cannot, as an individual, just put these coordinates into Google and use that in and of itself. So you have to have a software program that's going to convert it from a PDF file into an Excel file, and then a second program that's going to convert it from an Excel file into what we call reverse batch geocoding, which takes all those latitude and longitude coordinates and pops out physical street addresses. That is what the state does on a vast majority of these audits for people who have AT&T wireless, is they do all of that process for you. They review your AT&T records, and then they send you a day count schedule saying, we've reviewed your phones, and this is where they've placed you. There are a couple of other carriers, T-Mobile, Sprint. You cannot get access to them, first of all, more than 18 months. Second, without a court-issued subpoena or warrant. And the only other phone record that's sort of out there that we've seen is Vodafone, which is primarily used in the UK. That will break it down by European country, and when traveling within the US, they'll show US roaming calls. So those are sort of the three primary issues related to cell phone.
And just a little plug, I know this isn't an Ask Tim webinar, it's an Ask an Auditor webinar, but just a little plug. Kristine and I actually just wrote an article on this whole topic of cell phones and how they're used, that if folks are interested, shoot us an email after the presentation or go to our website. It's on our website to check that out, but it sort of talks through all the stuff Kristine just went through and really highlights the fact that along with Monaeo, technology has changed a lot of the way these audits run, and cell phones are a great example of that. So next question, Nishant?
Yeah, right. So just carrying on that topic of cell phone records, Kristine, what are some of the issues that you're seeing with cell phone records, especially as you've seen them with Wi-Fi calling, etc.? Can you help the audience understand what's happening there?
Yeah, so as taxpayers and individuals begin using some of the more advanced calling features of smartphones, so in particularly Wi-Fi calling, they also use services like call forwarding. These are things that AT&T and Verizon aren't tracking your physical location of. So if you are either an AT&T or a Verizon user, it's not going to attach to your physical location. Verizon on their bills is going to say, you are in the location of your area code, and AT&T is just going to return no latitude or longitude coordinates for that call. So AT&T is going to create an issue because you're not going to get any data on that call relative to your physical presence. And Verizon, unfortunately, sort of in late 2017, began simplifying certain plans and bills for their consumers and removed a column on their Verizon Wireless bills that was called usage type. And that usage type would define whether or not these were Wi-Fi calls versus traditional mobile-to-mobile calling. Not a huge deal if you live in California and you're making, Wi-Fi calls with a New York area code, because it'll show California, New York, California. It's pretty easy to identify. It is a big problem, however, if you are a Verizon Wireless consumer who uses significant Wi-Fi calling, you have a New York area code, and you live in Connecticut, because what will happen is you may make a regular mobile-to-mobile call in the morning at 8 a.m., you then make a Wi-Fi call at 10 a.m., which will show up as New York, and then maybe subsequently later in the day you make a Connecticut phone call, regular mobile-to-mobile calling. So your Verizon bill will now show Connecticut, New York, Connecticut. And it'll be your responsibility and burden of proof to show that you physically were not in New York on that day.
Okay, that's great. Another issue that typically comes up with carriers is tower jumps.
Mm-hmm.
What have you seen? How have taxpayers managed this in audits when the state may be looking at their cell phone records that you get from AT&T or any other carrier versus when they have something like a Monaeo?
So to understand what tower jumps are, or pings, a little background on cell phones. So cell phone signals, your cell phone isn't going to go, it's going to try to go to the closest cell tower to your physical location, but there is also a lot of other variables. It's going to go to the path of least resistance, let's call it, taking into consideration bodies of water, concrete barriers, land masses, the height of cell towers, the density of buildings, etc. So it is not unusual for a taxpayer who's, living in Connecticut on the border of the Long Island Sound to actually register cell towers across the Long Island Sound in areas like Great Neck, New York. Those are more obvious, again, sort of like our Wi-Fi description. What's less obvious is those who live in areas like Greenwich, Connecticut, close to the border, they're running errands, and they're pinging cell towers across the border in Port Chester, New York. There's actually a high school on King Street in Connecticut that is so close to the border that it actually straddles both state lines. The White Plains Airport also, if you land on the runway, you're close enough to Connecticut to be considered in Connecticut, and as you drive to go get your car in the parking lot, you're in New York. So those specific areas are cause for concern. There is nothing within your AT&T wireless bills or your Verizon wireless bills that are going to differentiate how close you are to those addresses or those coordinates. Many of our clients who have these issues or have had them in the past have downloaded and become Monaeo clients, because the one thing that Monaeo offers is that in this pinging situation, so that the same thing will happen with Monaeo. Your phone is going to do what it's going to do outside of any application that you put on your phone. But Monaeo can tell you the accuracy rating of how close you are to that particular site, and it's going to also afford you the ability to pull a Wi-Fi signal. So what happens in the scenario I described is you're in Connecticut, you ping a White Plains cell tower, but you're also at home connected to Wi-Fi, browsing the internet. I'm going to see a tower jump for Port Chester, New York. It's probably going to tell me it's got an accuracy reading of roughly 2,000 meters, but then subsequent a few minutes later, I'm going to see a ping in Connecticut with an accuracy reading of 65 meters. So what that tells me is that it's more likely than not, obviously, that you are physically present in Connecticut versus Port Chester or White Plains or across the border, and that'll provide you a much better audit defense than just the AT&T records alone.
All right. So another question from the audience, Kristine. So how many years can New York go back on an audit?
So New York has the capability of auditing any tax return that's within this, what they call the statute of limitations. That's traditionally 3 years. So 3 years from the date you filed a tax return. There are special instances that allow the tax department to look beyond that 3-year statute of limitations. They are going to be for something called substantial understatement. So if you have underreported your tax by 10% or more, your income by 10% or more, they can open up those returns. In a non-resident scenario, failing to source or report yourself as a resident does not generate a significant understatement. This would have to be a significant understatement in the federal column of a non-resident return. So you have just essentially not reported income in excess of 10% or more of your federal adjusted gross income to trigger that look back. Also, the statute is wide open for any years that the department has, inferred that there is a good likelihood that you filed your tax returns fraudulently. It's not that they can just say, oh, we think there's fraud in any audit. There has to be some sort of proof or someone's contacted the tax department, but if the department believes you've committed fraud, they can go back as many years as they'd like.
And Kristine, sort of related to that and tying into the question we had previously about income thresholds, does that sort of look back period come into play for income thresholds? Like, are they looking back, oh, this taxpayer, made $1 million every year in the past 5 years, but in the year they move, they only report $100,000 of income. Like, is the focus in terms of audit likelihood on the year of the move, or do they look back and sort of add up all the income that they used to they had in prior years?
I don't think that there's as much of a look back with auditors unless there's an issue that there's been unfiled tax returns in the past. So if you haven't filed a tax return and all of a sudden you come onto the scene with a New York non-resident tax return reporting source income of a couple $1 million and you've never filed a tax return previously, but all of a sudden you're filing a tax return and your facts haven't changed. You have the same employer, you've been living at the same address. I think that the department's going to be skeptical that in years past, like, why didn't you have a requirement to also file a tax return? On a going forward basis, as it relates to changing your domicile, I think that the department is always skeptical about potential going forward revenue that they could lose, but that's going to be on almost all non-resident audits. You know, and most of these domicile cases, or a large share of them, usually have some type of significant income event in some year surrounding the change of domicile. Not all, but a lot.
Okay. So a related question on that, but on the other side of the timeline, if a taxpayer wins an audit, does that basically mean that they're done? They're never going to hear from the tax department again on the residency issue?
Yes and no. So let me go into that further. The tax department audits for compliance. Once you're deemed compliant by one auditor, they're not going to recommend you for a re-audit. So at the end of every case, there's a closing section, and you're either recommended or not recommended for re-audit. You'll see this in any FOIL that you place with the tax department on a disagreed case. However, if the dollars are high and the day count's close, there's nothing precluding another auditor from pulling a subsequent audit. The rule is that, especially for statutory residency, each and every year stands on its own, and unless the taxpayer can document some type of true harassment or retaliatory behavior, there's not anything that a taxpayer can do to thwart off continued audits. And even in the case, I mean, the level of what I talk about harassment or retaliatory behavior is incredibly high. I mean, obviously, people don't like to be audited or subsequently re-audited, but this has to be true transgressions by a state employee, clear ethic violations. But the best going forward audit defense is both a record of compliance and above average record keeping. What is above average record keeping? Making sure that you have layers of documentation that support sort of where you were every couple of hours or, you know, down to an hour each day. You're not going to get that from things like your Outlook calendar and your credit card statements. These are going to be, you know, the new technologies like using Monaeo. I've seen clients take this to the extreme. I've had an individual install fingerprint scanners in each of his homes to record his entry and exit. You know, especially when you're spending up there in the 181 to 182 days in the city each year, you have to have 100% precision with those records and with your counting abilities. So that's how I'm going to leave that.
Okay. Another question from the audience. So, Kristine, how are married couples treated? So, married filing jointly, is the 183 days aggregated? If both spouses spend 100 days, are we over the count, or is it separate for each taxpayer?
So the statutory residency count is separate for each taxpayer. Your records should be kept separate. Your count should be kept separate. And while the question, there's not two spots on a New York State tax return, obviously, to report how many days you spend in New York. So the instructions say that you have to report the higher of the two for you or your spouse. In the event that one spouse exceeds the 183-day threshold and the other spouse does not, they don't have to file a married filing joint resident state tax return. The laws of New York allow married filing joint federal taxpayers to file separately at the state level if their residences are in fact different. It works at the city level the same way. Just because you are both residents of New York State, if one spouse is a resident of New York City, you can pay city tax on an IT-201 proportional only to the spouse whom is a resident.
All right, cool. So another question from Scott. Kristine, advice for clients who live in Connecticut but work in New York and their primary office is in New York, but on Friday they would prefer to stay home in their pajamas and work at home. Like the question from Scott says right now they're subject to double taxation because New York will tax that day and Connecticut won't give a credit for that day. Now, I'm asking the question. I actually know the answer, but
yeah, I was going to say I'm going to punch you because I'm pretty sure that the legislation has changed on that issue. So, Scott, they are now the convenience rule was adopted by Connecticut. It's not physical presence. So, if you work at home in Connecticut for your New York employer, you'll get credit as a New York workday and be able to take a resident tax credit for that.
Okay, good question, Scott. Actually, while we're on Connecticut, another Connecticut question came in. Maybe the question is, can you speak to Connecticut on these matters, and is Monaeo useful for that? So Connecticut residency issues, Kristine?
Yeah, so while we primarily focus on New York State issues, obviously, Monaeo is useful for all states that have any type of residency limitation. So for instance, I had a recent client who contacted us because he moved out of New York to Tennessee. He's now a Tennessee domiciliary. He actually has absolutely no connection whatsoever any longer to New York. But he wants to accept a job in Minnesota, and Minnesota also has 183 days. So I told him, he said, what can I do, Kristine? And I told him, you can download Monaeo and use Monaeo for your Minnesota tax audit should one arise. Monaeo also works in how many countries, Nishant?
It's 180 countries.
180 countries. I've yet to see a country it hasn't registered in. So again, we're using Monaeo for 548-day clients who are, expats living abroad or avoiding state tax for a particular year-and-a-half period related to a large capital gain event, and tracking them pretty much anywhere in the world at this point.
And sort of, while on the topic, question from Peter G. Peter asks, related to that, Kristine, are Monaeo location records accepted as proof of location by the New York Tax Authority?
Yes. So we have gone through numerous, probably well over a dozen or more audits at this point where we've submitted Monaeo as proof on an audit. It has been accepted. Some auditors have seen it and are aware of it. Others, we've had to just simply explain it. Honestly, my most common response from auditors is, kind of like, how cool is that? Like, I don't think that the audit department didn't expect that taxpayers or their representatives and the industry in general was not going to come up with a solution to allowing taxpayers to harness their own data, right? The department started turning your cell phone records against you in these audits. Why shouldn't you have the ability to know what your phone is recording before the department does?
Got it. Okay. We're kind of bopping around here with questions from folks. One question was statute of limitations. So this question from Lisa is, does the statute of limitations rules that you talked about for New York follow the federal? And maybe the question, Kristine, is more sort of the New York statute of limitations maybe staying open if there's a federal audit, like maybe talk to that briefly.
Okay, so just to be safe, yes, the statute of limitations sort of rules mirror what the statute of limitations rules are federally. However, if you undergo a federal tax audit, it will keep a New York State statute of limitations open indefinitely until the conclusion of your IRS audit. You have 90 days, I believe, from the conclusion of your IRS audit to report those changes to the state of New York. Failure to do so results in significant penalties if the state were to find out about those changes, and there is definitely a program at which the IRS shares its data with the states regarding whom has undergone audits. There is not a reverse reporting requirement. So if you have undergone a state audit that's resulted in an adjustment 4 years after you filed your federal return, the IRS does not open its statute of limitations for the states.
Perfect. So, Kristine, sort of another day count question. We were just talking about work at home days in Connecticut. Another question, from someone who works from New Jersey. So, if I work from my New Jersey home for my New York based employer, does that count towards the 183-day test for statutory purposes?
No. So it's important to differentiate between statutory residency and workday allocation. So for statutory residency purposes, you're talking about your personal physical presence within the state. So you have to cross the jurisdictional borders of New York State for it to count as a New York day. So if you work from home in New Jersey every Friday, you can obviously use that to effectively avoid being a statutory resident of New York State if you have a pied-à-terre in Manhattan or whatever the case may be. But if you are working from your New Jersey home for your own convenience, that day will be, from a source income standpoint, that wage income becomes allocable to New York. So in a situation of a taxpayer who, 100% of their wage income comes from their New York employer, all they do is basically go to their New York office and work from their home in New Jersey and have a vacation home in the Hamptons. There may be little to no tax differential between them spending more than 183 days in the state and them not, because again, 100% is going to be sourced to New York regardless, so whether or not they're held to a resident or a non-resident isn't going to be as impactful.
Okay, Kristine, that's great. Good question. Please keep sending questions in. We have about 10 minutes remaining. We want to make sure that we are answering anything that you may have on your mind. Kristine, a tactical question. Do you think that it is better to have the auditor come to the office to do the audit, or should I just send the information in the mail?
So I, and as being an auditor, say that at least in those initial meetings or, where you're just producing a large amount of documentation, leave it up to the auditor. Some auditors love to travel in the field. Other auditors don't want to. I know as a woman with, small children, it's not as easy for me to travel as maybe some of my other counterparts. So I think that for those meetings to just review documentation, it should be personal preference to the auditor. However, as the case progresses, there may be reasons to have meetings with auditors or their supervisors, so we find that they're usually more helpful in negotiation standpoints, or you're trying to reach a settlement, that often face-to-face meetings are better to do that. Whereas if you are in a heavily disputed residency case that revolves around hundreds of disputed days where you feel like the tax department or the auditor is being particularly unreasonable about their review, I wouldn't suggest sitting down in a room and going sort of back and forth with your auditor on that, because we just know that they can get contentious and they don't often lead to much resolution in those meetings by sitting down and going day by day.
I will say that we just moved to a new office space in New York City last year, and we actually specifically built into the plans 2 carols for auditors to sing. I mean, a lot of auditors like coming in the field. We have, clean bathrooms and whatever, but
I think it depends on the location of where you are. Yeah, if you are a CPA in Connecticut, chances are they're going to be less likely to want to come to your office location than they might want to be if you're located in New York City, because, again, the commute for them is going to be a lot easier if you have a New York City-based office than those spread out across the state.
Okay. So a follow-up question on that from a process perspective. Do auditors care if a case is not settled and that it goes to appeal?
No, so there is no incentive for auditors to settle anything other than the way they feel is the right result. There is no sort of contingency or promotion or anything tied to these cases. Obviously, we could understand that that would be, a significant ethical concern on the transparency of the tax department. So they are just doing their best to carry out their job functions. As we might feel that they're trying to make our lives overly difficult, it's just not the case.
Kristine, another question. For non-resident wage allocation audits, do cell phone records matter?
Yes. So cell phone records are requested in almost every single audit we see now. I would say 90% or more. Why is because it's just simply easier. Going through that type of technology is easier than sitting and having to go appointment by appointment through somebody's Outlook calendar. It's easier to track travel for your employer. You can very easily determine whether or not they're working from their home or a bona fide office of their employer in their home state. So someplace that's outside of their home. So again, they're using those latitude and longitude and physical address coordinates to really figure out exactly where you're working. Are you doing something for your convenience, or are you doing something out of your employer's necessity?
Okay, next question might be more of a domicile-related question. So question is, I have homes in New York, New Jersey, and Florida. I spend 100 days in New York, 100 in Florida, and 100 in other places. So is New York going to dispute that I'm a resident of Florida? And I'm assuming that this taxpayer has done, voting registration and driver's license and all that sort of window dressing stuff. But with 100 days in New York, Kristine, and 100 days in Florida, how's that taxpayer's Florida residency case looking?
So it depends on where you lived at the outset. If you're a traditionally historic Floridian and you spend 100 days in all of those places, then your Florida domicile will continue. It's not clear and convincing that you've left Florida or abandoned Florida for either New York or New Jersey. However, if you are previously a New York or New Jersey resident claiming that you have moved to Florida, it is going to work in the reverse. It's not going to be clear that to the tax department that you've both abandoned New York or New Jersey and taken up anew in Florida. You have to both leave and stick the landing. Most taxpayers who win their residency cases have to spend twice as much time in their new state of domicile as they did in the historic domicile. So that would look like 240 days in Florida to 120 days in New York if you were moving from New York to Florida. If I had $1 for every 6 months and 1 day comment I heard, I would be retiring much sooner.
Right. So yeah, and that issue is, you know, the bigger the ratio between those two sets of locations, Florida and New York, the better your case is going to be.
Yes, and there's a lot of gray areas for those taxpayers who obviously can't get to that 2-to-1 ratio. Obviously, the best domicile case is you sell your historic residence in New York and you move to Florida and you don't come back. But, you know, sort of between there and spending 183 days in the state lies all the gray domicile cases.
Okay, so we got another question actually specific to Monaeo. How does it work? And what's so good about it is the question.
Okay, so Nishant, I'm going to have you explain how it works because you're going to do a better job than I am, obviously.
Sure. So Monaeo is an application that you download on your phone, and once installed, it basically works in the background using 3 different technologies on the phone, which includes GPS, but also includes Wi-Fi and cell towers to keep a record of where the individual has been at various points in the day. Now, the way it's been built has been built with practitioners as well as in conversations with the New York State Tax Department. So there are a number of auditability features that are already built into Monaeo that basically allow the auditor to be able to take a look at the record and be able to identify whether that is a record that is created by the machine or something that may have been altered by the user, which obviously is critical from an audit perspective.
Okay, great. So next question.
Let me answer from my perspective on what's so great about it. I pride myself both from when I was an auditor and now on having as much as unbiasedness as I can. And I'm doing this in conjunction with Monaeo because I firmly believe in the product that they put forward. So let me tell you what I think is really great about it. I use Monaeo to help clients who've either gone through multiple residency audits in the past, are contemplating changing their domicile, have changed their domicile and are waiting and expecting an audit, to help them monitor their time and their issues with their residency in real time. Monaeo, in addition to the application, has an online website that allows me to correspond with its server. So I monitor more than 40 Hodgson Russ clients on any given day. I can basically tell you where they are within the last 3 hours. I know that sounds big brother, but there is a level of security in that we found that a lot of our clients sought in not, even if you have an assistant recording, whether it's a New York or a Florida day, sometimes people just want to be able to pick up the phone and give me a call and say, Kristine, can you just take a look at my Monaeo on this day and tell me, look at the data, is this going to qualify as a transit day? This is what I did. And I'll say, yeah, it qualifies as a transit day. You can mark it accordingly. So it's just having that expertise and that set of eyes in real time that I believe is the, real power behind the application.
All right. We're getting close to the end here. I guess we got time for one more. This is maybe similar to the 100 days question we had a second ago, Kristine, but someone claims to move to Texas but isn't able to be there, for more than half the year because of travel, largely for work, and is sort of bopping around in lots of different places. New York City, how are they going to look at that?
So when we look at a domicile count, we're looking only at the location of your, new domicile time to that of your old. So in that scenario, you can't spend more than half of your year in Texas. So let's say you can have 170 days of that year in Texas, and you're traveling, 180 days a year. So of that 170 sort of remaining days that you're not otherwise traveling to locations outside of New York and Texas, how much of the 170 remaining days did you choose to spend in Texas versus New York? If you tell me you spent 20 days in New York and you spent 150 days in Texas, great. I don't care that you didn't spend half the year in Texas. You still have a really good domicile case that you moved to Texas. If, though, you say that of the let's make it 180 days, left after traveling to other places, you spent 90 days in New York and you spent 90 days in Texas, well then, again, I don't think that you have, absent any other factors in your life, the home, near and dear, et cetera, you probably don't have as clear and convincing of a case as the prior individual I described.
Okay. So it's 2 o'clock here, guys. We do have a couple of more questions. Kristine, you wanna go for it? Yeah, folks, if you need to hang up because you got a hot date or something, go ahead. We have a couple more questions that we might as well get to. One question. So for joint New York returns, Kristine, where does it say that you list the highest of the 2 day counts for the spouses?
So it should be within the instructions to the IT 203, whatever, I don't know it off the top of my head, but the instructions on that particular line item.
Right, it's on the instructions?
Yeah,
that's
in the instructions.
Okay, all right, and last question, the wife lives in New York and the husband lives in Florida, a recipe for a happy marriage. So the husband meets the days test, so says the questioner. How do you file or address the residency in that situation?
So this happens not often, but it does happen. I'll give you a great example of it. Sometimes people want to move and they have almost adult grown children. Most of their children have graduated and gone on to college, and they've got one straggling kid left behind, and they're in their senior year of high school. And but for whatever reason, maybe it's tax motivated. It doesn't have to be anything less than that, or more than that, I should say. They want to move to Florida, and one spouse, the husband, has the ability to move to Florida, and the wife does not. I think that when we come across this situation, I say that for all of those of us who are parents, we can agree that while there are tax issues in our lives, there are also personal issues, and not many parents are going to uproot their children from New York in their senior year of high school and move them to Florida. So we do see times where wives or even minor children may be left behind for a period of years. That is not going to be necessarily the best fact, because obviously the family factor is one of the 5 domicile tests, but in and of itself, it doesn't ruin your case. You can certainly move to Florida without your spouse. The law allows you to have a separate domicile from your spouse. As long as you do it clear and convincingly, you can file in that manner. You can file a married filing separate state return, where your spouse files an IT-201 and you file an IT-203, or you don't have to file a tax return at all if you don't meet the thresholds of the filing requirement. All right.
Well, guys, this was great. I mean, really appreciate all the questions coming in. We should probably do this again since we had so many questions. But if there's anything you were too afraid to ask or asked and wasn't adequately answered, although sounds like impossible. Kristine did a great job. But if there's any other questions you have, you know where to find us. And happy to chat or send us an email if you have any other questions. And Nishant, I don't know, any closing words for our group?
Thank you, everybody, for taking the time to join us. As Tim mentioned, please don't hesitate to reach out. We will be circulating our contact information, so if you need to reach out to us, have any follow-up questions, anything that we can help with, more than happy to do so.
All right. Thanks, everybody.
Thank you.
Have a good afternoon.